Good morning, ladies and gentlemen, dear guests. After the successful conference Future Europe, Sustainable Europe on the 1st and 2nd of July of this year, we agreed to meet twice between the annual conferences at the Global Roundtable. I may welcome you to the first Future Europe, Sustainable Europe Global Roundtable. Together with our partners DZ Bank, Deloitte and Morningstar, we are more than delighted to discuss here at our studio at WeWork and online the following three topics in 3 sessions. First, the role of the fixed income market on Europe's sustainable recovery agenda. Second, the EU's Sustainable Finance Action Plan. And third, sustainable finance, a fundamental reshaping of investment management. We hope that these topics sound relevant to you. However, we know that these topics only tackle a fraction of what is needed to become carbon neutral by 2050. However, I trust that with joint efforts from all industries, we will be able to reach our goal. I'm delighted that the sustainable community is back together. Thank you for accepting our invitation. I may now hand over to Frank Scheidig, Global Head of Senior Executive Banking at DZ Bank and member of the Sustainable Finance Committee of the Federal Republic of Germany. Frank, good morning.
Thank you very much, Nada. Good morning to you. Good afternoon to Asia Pacific, or good evening to the Pacific Rim. Good day to Middle East Africa, and good morning to Europe. Thank you very much for coming in. We have more than 500 participants from all over the world, probably not so much from America because it's very early in their day. Anyway, having said that, I'm very glad that we have today the opportunity with the mentioned partners, the Malecki Group, OMFIF, who will help us to assist and moderate. In that respect, John Otchard, whom you might know from his previous job at Euromoney, and not to forget Deloitte and Morningstar, with whom we have teamed up as well under the guidance of the Malecki Group on the 1st and 2nd of July when Germany took over the EU presidency. COVID is dominating our daily lives, unfortunately, still. But I'm proud to be a European, I have to say, because Europe is shouldering this pandemic quite professional. If you see the tremendous issuance program from the SSAs and the private sector to finance these difficult situations, I can just say with French word chapeau, I have to say I'm very proud to see that, how professional this has been handled. But today we want to discuss the SSA sector in Europe with our partners and long-term counterparts. First of all, the EIB, Ayla Cravey and his team, also to mention a gentleman who's in charge for the sustainable issuance, Aldo Romani, who gave us the first SSA bond in Europe ever as a climate awareness bond 11 years ago. Then the second partner is the ESM under the responsibility and guidance from Kalin Anef-Janse. By the way, congratulations to yesterday's announcement. Today it is in all the news that the ESM becomes a backstop for the Single Resolution Board, which will make all the financial sector and industry in Europe definitely stronger. And it's good to know that the ESM is standing its man. Thank you very much. Thirdly, I will also definitely mention here the Council of Europe. Council of Europe, even if it is a smaller issuer, but a very delighted, focused one if it comes up to social issuance. Under the guidance of Governor Wenzel and his team, which is run by Felix Grote, they have done a tremendous job over the past 12 months, also financing to fight COVID-19. Thank you very much to join us in the third panel and to end today's discussion round. And then that brings me to the, I can't say new kid on the block, but the most and the largest customer and counterpart and SSA, I have to say multinational issuer, which is the EU. And that brings me to a person I have to thank a lot and his team, which is Nigel Bohan and his head of the funding side, Jean-Pierre Reyes, and his team. They have done an unbelievable job so far under the SURE program, which is there to support the short-term workers at the European member side of the EU. And they have funded in a very short period of time very successfully. I think that was the largest books I have ever seen in my over 30 years of a career, with nearly in the first time over 200 billion interest, second time over 175 billion interest, and now even in the single tranche of the 15 years, more than 100 billion. That shows how much these quality credit is demanded and how the world sees Europe as a very, very sustainable time zone and rim. Again, big thanks to all of you. But let me now hand over to a very honorable man. I have to say it is my pleasure to have him here today for all of us and to give us an initial speak before the first panel starts. I talk about Mr. Gert-Jan Koopman, who's Director General in charge for the EU and the Commission for the budget. Gert-Jan, very welcome, and we are delighted to listen what you have to say. Gert-Jan is also the father of the so-called Next Generation EU program, which will kick in and to become funded and started next year. It's a 750 billion program that shows you what alternative that means and brings. And it gives the world, in my personal opinion, for the very first time, a serious alternative for huge investors who seek for liquidity and quality through the US Treasury market and the currency US dollar. Gert-Jan, thank you very much for all of these things you have done so far with your team. I would like to hand over, and we are very delighted to listen to you for the next 10 minutes. Gert-Jan, the floor is yours. Thank you very much.
Frank, colleagues, thank you very much. Thanks for having me. Let me just ask whether you can actually hear me. Very good, lovely. Listen, I'm delighted to participate in this global roundtable for various reasons. First, because I think your scope and the breadth and depth of themes you touch upon are central to where funding markets are going at this juncture. And secondly, because of what you just said, Europe is responding to this crisis very differently from the way it responded to the previous financial crisis. Let us be honest, whilst we got some things right last time round, we got many things wrong. And I think it's fair to say that this time round, the Union has learned some important lessons. The principal lesson we learned, I think, is the need to collectively respond as a very intertwined economy, both in terms of its internal market, but also because the countries share the euro and their individual response capacity is obviously, as a result of this, limited. So what we have seen, I think, is a relatively rapid realization that we needed more aggressive fiscal policy. And secondly, that this needed to be coordinated at the European level to avoid a fragmentation of the internal market and divergences occurring within the EU. And whilst it took a few weeks, not very much more than that, for this to sink in, the third decision that was taken in this regard, I think, really is emblematic of where things have moved. And that decision was to entrust the European Union with the coordination of this program. So you already referred to Next Generation EU, which is, I think, critical as a response strategy because it really addresses the fundamental risks that the crisis is posing to the European economy. And in that context, it was also decided that the Union should be empowered to borrow um, on the capital markets to fund expenditure, central expenditure, EU-wide expenditure, to be repaid through the European Union budget over a very long period of time. So that, I think, is radically different from what anyone envisaged 10 years ago, radically different from what anyone could have envisaged only a year ago. And I must say, when we entered those discussions in the spring of this year, um, it was indeed one of the most thrilling experiences we've had at the European Union level in terms of a common purpose, a common resolve to address major challenges. So what this has resulted in is effectively the creation of a very large new supranational issuer with a policy that will be focused on ensuring that this unprecedented economic package can move forward. But in the process, it will also uh, allow us to build a much stronger European capital market by providing what is effectively a safe asset uh, with a yield curve that could become a reference going forward. And to the theme of today's roundtable, by putting a strong emphasis on ESG features, we will also be able to develop this market, which is a very European market, as you all know, much more deeply going forward. So by doing that, and I think you were already alluding to that, Frank, we will effectively also be strengthening the role of the euro, and thereby the functioning of the euro in the international capital markets. So on the back of its primary purpose of financing the economic response strategy, we actually are looking at these intertwined secondary objectives, which actually are crucial and which provide, I think, a once in a generation opportunity to get the euro area back on track in this regard, and for the European Commission to issue debt at an unprecedented scale. So Niall and his team, Jean-Pierre, but many others, are building effectively a 1 trillion euro bank in current prices. We presently have a balance sheet of about 65 billion euros, with the issuance that is now foreseen under SURE, under Next Generation EU, under macro financial assistance and balance of payment support. And looking at the assets we manage, we would be looking effectively at a balance sheet of about 1 trillion euros in 6 years' time. So it's a huge transformation for the European Commission, a huge transformation, I would say, for the EU. And we are investing very heavily in this. Let me, against this backdrop, say a few words about some of the key features. The first, of course, is that we don't start from scratch. We have had a reputation as a long-standing supranational issuer, as you know, under the MFA, BOP, and EFSM programs. We have a balance sheet today of about 50 billion euros. Sorry, I should say in September we had a balance sheet of 50 billion euros of EU bonds. And that has given us experience from which we're scaling up. Now, since October, of course, we've started issuing the social bonds under the SURE program, and to date we've issued about 40 billion euros of social bonds, therefore nearly doubling our balance sheet. And we're indeed very satisfied with the market response to this. Order books have been very large. I think these have been some of the largest issuances in Europe ever, certainly largest issuances for supranationals, and the pricing has actually been rather good and has improved. Prices have tightened going forward. Now, that's where we start from. SURE, of course, is not finished. We have a remit to put about 100 billion euros of loans to member states. So there's about 60 billion euros still to go, and that will be completed in the first half of next year, essentially using the model we are relying on to date, which is leveraging the syndicated borrowing approach that we have been pioneering in our quarters over the past years. But looking ahead now, it is clear that we will need to go much further. And that is not just a quantitative issue, it's also a qualitative issue. We will not just be working through syndications. We will need to develop a wholly new funding strategy, which essentially will have to be a diversified a funding strategy where we decouple the borrowing from the on-lending, for the very simple reason that, as I explained, a lot of the borrowing we will do is to fund expenditures programs. And therefore, we will also need to avail ourselves of a liquidity pool, which means that we will need to issue short-term paper. We will move forward to exploring auctions for raising revenues, and that allows us essentially to become much more like a national DSM, a DMO, a national DMO with a very structured, regular presence in the markets, and with a much more independent functioning system, allowing us to fund the needs on the on the usage side. So we expect Shore to be finished in terms of borrowing by the early summer of next year. And then we move towards next generation EU. We expect the present turbulence, I should say, relating to the position of Hungary and Poland to be resolved in the next few weeks. And I am confident that our schedule going forward for next generation EU will not be affected very much by this. And therefore, the plan is to start issuing under this program in the summer of next year. Now, just as the Shore program has benefited greatly from the social labels of these bonds based on a social bond framework that was endorsed by the ICMA, we believe that next generation EU will, to a large extent, benefit from a green bond label, since we target 30% of the issuance to be green bonds. We expect also to be issuing across a wide range of tenors. As you know, for sure, we have to date put 5, 10, 15, 20, and 30-year bonds in the market, building the yield curve. I would expect next generation EU to be very similar, as I've said, coupled with more short-term issuance, so bills. And the green bond framework here, we believe, will have to be, given its size, designed very carefully. You will benefit from a separate panel in this conference featuring my colleague Bernhard Windisch, who is leading the work in DG Budget and in the Commission on this particular feature of Next Generation EU. But in essence, we will be trying to emulate the best-in-class green bonds that are out there today, developing an ICMA compliant framework that is compliant also with what is available and what can be reported from the taxonomy, with over time a greater alignment of the two frameworks. Now, what is important to say here is that we are not issuing to fund projects we invest ourselves. A lot of the expenditure, I would say the bulk of the expenditure, will run through the Recovery and Resilience Facility, the main expenditure program, which is based on national plans that need to comply with an EU framework, but it is the member states who will be investing under these national plans. One critical feature of these national plans is that they will need to be designed in such a way that 37% of the expenditures support climate transition policies. So these are typically policies that support renewable energy, energy efficiency, sustainable transport solutions, etc. Um, these investments, therefore, will give rise to what we would call green expenditure. They will be measured against a reporting framework that is enriched, is based on the Rio marker system, but enriched with taxonomy elements where these are available. And that information will allow us to report and track the expenditure so that investors know that they're actually investing in genuine green bonds. So with a 30% green bond target, a 37% climate expenditure relevant target, we believe that whilst ambitious, this is feasible. So um, the relevant expenditure will be verified and logged in the national plans, and that will allow the Commission, therefore, for the green bond issuance to ensure that across different national plans, the relevant green bond issuances actually are fully compliant with the standard. Naturally, as I've said, this will be a subset of the integrity of the NGO funding, which will be larger. But this approach, we believe, will also help us to incorporate safeguards to avoid any double counting for any national public finance, which may otherwise issue this as national green bonds. And it will also avoid any difficulties with greenwashing. Now, a lot will therefore depend on the plans. A lot will depend on the precise nature of the reporting system. The plans, as you know, are scheduled for end April 2021. I can report that discussions on these draft plans are already ongoing, um, but it is still early days, and therefore we are not yet at a point where we can validate the level of ambition. Um, Secondly, we obviously are still finalizing the legislation, which is being negotiated by Parliament and Council, and where the reporting issues will be critical. However, there is a very strong demand for an ambitious reporting system in Parliament, and I am confident that Council will also follow this. So with that, we will have a very ambitious funding strategy in terms of its green nature. But as I said, I think we need to see this more widely um, as a program that will support the integration of EU capital markets by providing a reference, a yield curve that over time could significantly assist all investors globally. I think, as I said before, that this would undoubtedly stimulate the international role of the euro, as Frank was already saying in his introduction, and the two together should make the EU a much more attractive investment destination across potentially a wider range of assets. So in conclusion, there is a lot to play for. This is a hugely ambitious program. I think we got the economic policy response right on paper. We got it right in decision making. We got it right in law. And now it's down to us to make sure that it actually works in reality. That's a hugely motivating challenge. My colleagues are working around the clock, but I'm confident that we will pull through and that this will be realized as we move into the next year as a very successful and emblematic program for European recovery and resilience. Thank you very much.
Yes, thank you very much, Mr. Koopman, Gerd-Jan. That was very informative and very detailed. I thank you for your honesty, and it should show the world of international investors what Europe does and what we stand for, particularly for sustainability. This is our topic, how fixed income markets can help and has helped in the past and will help in the future. Let's discuss that. I hand over to John Orchard, who will quickly introduce the panelists. And let me say, I have hope that America will cope up with us under the new presidency then of Mr. Joe Biden, who will take over in January. Let's hope for the best. Let's keep fingers crossed. John, the floor is yours, and have fun and enjoy the panel. Thank you very much.
Good morning, everyone. Thank you again for joining us. Fascinating listening to Gerd-Jan Koopman just now and then listening to the Ode to Joy. I think there'll be quite a lot of joy in the euro-denominated bond markets based on what we've just heard. It's a transformational new issuer joining the party, and we'll explore that a little bit here. I'm John Orchard, the CEO of OMFIF, and welcome to this panel on the role of the fixed income market in Europe's sustainable recovery agenda. We've got a great mix of investors, issuers and policymakers for you here today. On the issuer side, we have Ayla Creevy, many of you will know, head of capital markets at the European Investment Bank. And we have Fernando Rodriguez, who is advisor funding and investor relations at the ESM. We've just heard a bit about them, and both of those institutions are in Luxembourg. On the investor side, we have Christian Kopf, head of fixed income and FX at Union Investment in Frankfurt. And we also have Lars Dreyer Christensen, director of the portfolio manager team, hedging and treasury at ATP in Copenhagen. Meanwhile, from the European Commission in Brussels, we have Bernhard Windisch. We just heard about him too, head of unit performance-based budgeting in the DG for budget. So welcome, everyone. We haven't got long, but I think we can have a quick whip round these, particularly the green and sustainable SSA market in Europe. Sounds like it's about to undergo a huge growth in issuance across the board. Ayla, I want to start with you. You've been in this market a long time. Recent years, we've seen the trend green goes rainbow. In other words, more and more issuers are going beyond the pure green perspective. EIB started in green bonds a long time ago, 2007 already. And in 2018, you extended your sustainable funding from climate awareness bonds to sustainability awareness bonds. Can you talk a little bit about why you made that change?
Yes, thank you, John, and thank you for the invitation to this panel. Yes, indeed. Well, when we started in 2007, we made our green bond purely a climate bond. All the user proceeds go into loans that are somehow in the climate field. Then over the years, I would say then 3 years ago, 2017, we started to have push and pull both internally and externally. Why don't you do a social bond? Why don't you do a water bond, a blue bond, an education bond, or all kinds of good causes? So we thought that what we could do, because since we want to do things very thoroughly, like you see our climate awareness bond, the framework is very robust. It's very well defined what the use of funds is. We also tell very much in detail what we do, what the funds have been used for, what is the impact, and all of this is audited on top of that. So you can't really break up your funding program in 10 different pieces, which all goes through this kind of process. So we have to go about it differently. So we thought about this umbrella product, which gathers all other environmental areas. For example, we started with water, and then which can also combine social areas like health and education that we added about a year ago. So the idea was just to create another product which could then focus on other areas and climate, as we did not want to change the climate bond. Even the name would have needed to change. And this is a nice umbrella product in the sense that we can add different sectors there as we go. As we develop criteria, of course, taxonomy is a big reference point in this work, and also as we develop the impact metrics as well. So we want to give plenty of information and plenty of transparency to the markets, to the investors with it. So we just decided that this is a suitable way for us to do it without creating then a huge amount of work in different formats. So it was a pragmatic thing, and I think this year indeed it has proved to be a very good one, since we already have the health sector there, which has attracted a lot of attention.
So would you say, Aila, just a quick supplementary question on that, it's better to address the ESG market as a whole rather than to fragment it so early on?
Well, I think it's not. I'm of the view that it doesn't matter really how you sort of label it and how you fragment it, even as long as you do the right thing. So what matters really is that the right kind of decisions are taken when financing is provided, with the right kind of conditions and right kind of criteria. But of course, I do understand that having green bonds and climate bonds and sustainability bonds and sustainability linked bonds and social bonds and gender bonds is quite confusing. So the only thing I would say that as long as you provide additional information to the market and to your investors about how you use your funds and what is the impact of your financing, basically call it whatever you want, but do it thoroughly and do it robustly and do it in a transparent manner. What we are not great fans of here at the EIB is just putting a label on something without any further information. So we have decided to go a different route, and that is what I think is important, because we need to provide that information to the market at this stage when you still have very different approaches. Maybe in 10, 20 years, everything is sustainable and then we don't need this anymore. But I think for the time being, it is really needed in order to increase transparency. Okay,
thank you very much, Aila. Clearly, of course, you'll be led to some extent by your conversations with investors, and we're going to talk to investors in a moment. Fernando, the ESM has currently launched its social bond framework. Could you give us some insights into that, please?
Sure, yeah, many thanks, John, and very good morning to the audience joining today. Yes, I would like to provide first some background information on what is behind this new framework for the ESM and the reason for its creation. As you know, the ESM was included in the European policy response to the pandemic back in May this year, together with the EIB support for businesses, and also the SURE program of the Commission for Workers that Mr. Koopman already provided some background information. Our contribution in this response is to make available to all our member states up to 240 billion euros in the form of direct credit lines facilities under a new instrument called pandemic crisis support. And this new instrument is designed to finance direct and indirect healthcare, cure and prevention related costs due to the COVID-19 crisis. And therefore, it addresses a social issue which is threatening the public health in the euro area. In that sense, and given this social character of the tool, we decided to launch a social bond framework in June in order to be able to finance this new tool through the issuance of social bonds. Our framework is fully compliant with the ICMA social bond principles, and it has been implemented around the usual 4 pillars. First of all, and probably the most important one, as Ayla already mentioned, is the use of proceeds, by which the ESM, together with the member states, commit to use the funds exclusively to finance the measures related to COVID-19. Secondly, the proceeds for evaluation and selection, where we describe the governance process for granting this assistance and the selection of the expenditures that will be qualified as eligible social expenditures. And third is the management of proceeds. And here it's important to mention that we follow a very similar approach as other public issuers in the issuance of green bonds by setting a central budgetary approach. What does this mean? It's all the proceeds that we will get from the social bonds will be pooled and allocated to eligible expenditures, with the caveat that the total proceeds from the social bonds cannot exceed the predefined expenditures that we have. And last but not least, also very important, is the reporting. This is a crucial element for the investors, and as described in the ICMA principles, we intend to report on the allocation and the impact of these proceeds. In addition,
sorry, carry on.
we will also publish a report up to 1 year following the issuance of the first social bonds, and then the intention is every year thereafter until the allocation is complete. Yeah.
Okay, thank you very much, Fernando. So a clear hypothecation of the proceeds. We've moved away already from green, and now we're going to move back to green. Bernhard, Ursula von der Leyen, we've just heard it at the beginning of this session, announced that 30% of the 750 billion euro next generation EU budget will be raised through green bonds. Can you talk a little bit about what the plan is to develop the issuance calendar and program is there, please?
Yes, thank you, John. I'm a bit embarrassed by the fact that my Director General has already divulged a lot of information that I had in my speaking notes. But basically, let me try and highlight perhaps a couple of points and add a bit to it. So as you pointed out very correctly, the President announced indeed that of the 750 billion of Next Generation EU, 30% are supposed to be financed through green bonds. Now, as Gert-Jan pointed out, the largest part of what we are doing with the 750 billion will be implemented through the Recovery and Resilience Facility. And as you will be aware, the Recovery and Resilience Facility is supposed to, beyond the words recovery and resilience, what hides behind it, to support the twin transitions. So in a sense, a little bit like also what you will have seen and heard in the American space, the idea to focus on a different way of rebuilding the economy in Europe. So there's a large green role, and I think here I would like to support what Ayla has said before, that obviously is not so important in a sense how we finance things in a way, it's very important what we do with that money. And so I think it's very important to keep in mind that both green and digital are going to be a large part of the recovery and resilience facility. There will be a 37% target. All of these numbers are still under negotiation in Council and Parliament. So I think we are talking here about what is currently the proposal of the Commission. There will be a 37% climate target, and I think a lot of the money that we will raise through green bonds will go through the projects or the investments that have been identified as climate relevant.
Okay, thanks.
So, sorry, yes.
Carry on, Bernard. Carry on, please.
No. I was just saying.
I wanted to ask. Thank you for that. In terms of the specifics of the issuance, I'm sure that's still being finalised. But when would you expect the issuance programme to start in earnest? Obviously, there are still ratification processes that are being completed. We heard about earlier. But when would you expect the issuance calendar to develop, and how would you go about creating a yield curve? What are the broad plans?
So on that point, I have to say that, so as you know, the budget has not been decided. The next MFF is still under negotiation. But let's assume that we will get this hopefully very soon. The idea is that under the current proposal, the plans that the member states are going to put towards the Commission are going to be adopted around April, let's say May perhaps, to kind of give a bit of slip. But I think that the issuance program obviously has to be available at the time when actually these plans are approved and the member states have a reasonable expectation of being financed on that basis. So I think that towards mid next year, I think the issuance program needs to be in place, and it's a bit difficult to say whether we are going to start issuing at larger scale before, but most likely, as Gert-Jan said, is that we will need to build a liquidity pool with short-term financing first, and then build out the yield curve as we go along. And given the timing that I've just outlined, and all of this obviously assuming that there's no political accident over the timing, which we all have to recognize that still could happen, I think that mid next year, second half next year is probably a plausible and reasonable assumption on when this is going to take off in full swing.
Good. Okay, that's very useful. Thank you. Christian, over to you. You've talked a lot over the years about the importance, the fundamental importance of ESG-driven capital markets, and we've just talked about the move away from green bonds towards sustainability, and in the conversation we've just had with Bernhard back again. Can you tell us, as from an investor's point of view, what's going on there? Is the green agenda important in its own right? Are you more interested in sustainability? And how are you separating these issues as buckets as investors? There's a huge amount of due diligence work that you as investors have to do, which potentially is also standing in the way of the development of the liquidity of these markets.
Yes, so I would say that the green bond market for us from an investor perspective is still sort of in the center of our attention. We see a very rapid development of that market, even throughout the pandemic. 2019 has been a bumper year in the development of the green bond market. We tend to look at the ICE Green Bond Index to get an idea of the size of the overall market. And in terms of issuers involved, the green bond market has grown from 323 at the end of 2018 to 510 at the end of 2019. And it has continued to grow throughout 2020 to reach 688 index constituents at the end of September 2020. So you can see that in spite of the pandemic, we've had phenomenal growth in the green bond market. That also applies to the number of issuers involved. That has grown from 159 issuers at the end of 2018 to 224 at the beginning of this year to 280 issuers, where we stand currently at the end of November 2020. So phenomenal growth in the depth and diversity of the green bond market. And we've seen that development this year with the arrival of a number of very important issues to that market. We had the German Federal Republic issue green bonds, but we also had Daimler, the German car maker, VW, Stora Enso, a paper and packaging maker, just came out, issued a 10-year bond that now trades through its own curve of regular bond. And there is an important DZ Bank issue coming out today, a 500 million senior non-preferred issue at swap spots 50. So we see a very rapid and vibrant development of the green bond market. We have dedicated funds for green bonds, and we have a preference for further development of that market. Now, that said, sustainability-themed bonds also play a role, as do other sort of special investor vehicles that are being set up as we speak. But I would say our focus is still on the green bonds.
Okay, thank you. That's useful. Lars, with Sure Next Generation EU, we just heard that there's going to be a huge issuance program, a transformational issue, I think. The EU will start to look a bit more like the T-bill market over time, I expect. How are you navigating these markets as the euro-denominated SSA markets as an investor? Tell us where you see the opportunities and indeed problems, if there are any.
No, I guess it has always already been kind of alluded to a couple of times this morning that the issuance size and the market access, the liquidity, the building up of a yield curve from the SURE program and hopefully also from the forthcoming Next Generation EU program, that's definitely a huge opportunity for investors. It will provide that the market access in a quality name that can hopefully get existing investors to invest more, but probably also attract hopefully new investors into this market. But I also think that is obviously from the investor side. But I think we also need to look at a little bit more broad on this. I think it's a huge opportunity not only for investors, but I would say for the entire sustainable market. I mean, the issuance size, the order books we have seen from the SURE program so far. For me, it really strongly underlines the capability of the fixed income market in general to be that.
Sorry, just for the people that don't know, that the SURE bond was massively oversubscribed.
Yeah, absolutely was. It was massively oversubscribed, and to me that kind of underlines the capability of the fixed income market to be the enabler for securing or ensuring that size and scalability that I think also Ayla a little bit alluded to, that we can get that kind of acceleration of capital that is needed to ensure that we ultimately reach what we're here for, namely to reach climate targets and things like that. I think that's a very important takeaway as well. And another important takeaway for me, at least, is also it's a huge buy-in to the social agenda. Really, that investors kind of accept that if we want to have the green transition, we need sort of the social acceptance of that as well. And I think that's another very important takeaway. I think.
Okay, thanks. Lars, Ayla, we've heard about new entrants to the market. We've heard about sovereigns slowly starting their green bond programs. Finansagentur has done that. I know the UK DMO is thinking about it. We've got these huge new EU programs. The oversubscription, Ayla, suggests that there isn't a problem in the market and that people aren't confused. But do you? We talked about this before. Do you think the market is in danger of becoming confused by this proliferation of SSA issuers and then beyond that issue types, different ESG bond types?
Was that a question for me or
for Ayla?
Okay, sorry.
No, thanks, Lars. You're on mute, Ayla.
Yeah. Yes. So I don't. Well, it's going to be much more busy, of course. But then, of course, it's busy in any product, be it green or social or just plain vanilla normal bonds. So I'm an optimist just by nature, but I don't think this will be a big problem. I mean, we are all used to operating in very busy markets, and if we aren't, we certainly have to get used to it because that's what it is going to be next year. So I'm not so much worried about the demand and the absorption capacity of the market, because that, I think, is that there's so much liquidity around with all the central bank activity that this is not a problem. And actually, of course, for example, what the Commission issues is probably partly reflected as a reduction in the member states' issuance and so on and so forth. Or for example, ESM, the same. So that side, I don't think is a huge problem. There is so much demand. It's more about organizing so that we are not clashing all the time in the markets with a similar kind of offerings on the same day. And I should think that this is feasible. It's not something which is overly difficult for normal human beings, and we will talk. We will probably clash, some of us, at some stage to some extent, but that's also to be expected, just as long as we all have to keep in mind that we can't keep the market for ourselves. I can't imagine that the EIB, we announce something on Friday and we keep the next 3 days for ourselves in the market. That's not going to happen. So it's just a fact of life, and we have to live with it. As long as there's demand for it, I think we are fine.
Okay.
It's a better problem to have.
And as you say, there are, I mean, it is possible to conduct a conversation between, 15, 20 issuers. It's not beyond the wit of a man or woman to do that. Fernando, just to you on that point, there is an increasing proliferation of supranational bonds from the EU and its affiliates. Do you think the market is finding that confusing? So far, the demand seems to be there, but so you're not expecting problems there, and the coordination will work okay?
Yeah, no, I believe I fully agree with Ayla. I think the demand is there, and I would like also to emphasize the important role in the policy area and the work that the Commission is doing here. I really think we are on the right track here, and this means we are actually building and shaping today the sustainable market of the future. And I think Europe is doing extraordinarily well. As I said, the Commission is doing an incredible work in providing greater structure and clarity to the sustainable finance market with the taxonomy. And well, I cannot agree more with what Mr. Koopman already said before. The policy efforts and frameworks developed so far are much more advanced in Europe. The work being done will certainly have long effects on the global capital markets, and I am convinced the example of Europe will serve as gold standard in the industry at international level. So to answer your question, John, no, I don't think we will end up in a confusion market because we're building now the right tools to provide this clarity.
Okay, thank you. In the interest of time, we won't spend too much time here talking about taxonomy. I think that that's a slowly evolving scene going in the right direction. But given the amount of time we have left to run, Christian, I wanted to move to you on specifically integrating ESG factors into fixed income investment outcomes. Lots and lots of due diligence work to be done by investors. There's a huge proliferation of ratings, which the market will still need to sort out. And of course, there's a variance in pricing between green and non-green from the same issuers. How are you working through all of this stuff, Christian?
Yeah, so this is an extremely important topic for us as an asset manager. Union Investment has been offering sustainability-themed investment funds for 30 years already, so we have a long experience in that. And if you look at the history of ESG, integrating ESG into fixed income over the last 20, 30 years, it is always centered around exclusion criteria. Yeah, it started out with church banks and churches looking for investment funds, and they wanted to exclude certain investments, and then it has become more mainstream. Now, we are in the process of a total revamp of our approach to sustainability investment, of integration of ESG in our investment process. And I think there are two major changes here. The first one is we move away from exclusion towards a deep integration of ESG factors in our entire investment process. So this is very much data-driven, and we look at any investor that we invest in from two angles, from an economic angle and from an ESG angle. So they're complementary in analyzing the investment opportunity. The second change that we're undertaking is we're moving away from exclusions towards a transformation approach. So we look at how how issuers evolve over time in their efforts of integrating ESG aspects in their business practices. We look at the progress that they're showing. And what we've done at our firm is we've set up 18 sector teams that have developed key performance indicators for each one of the sectors we invest in. We've communicated those key performance indicators to the companies we're invested in, and we're tracking their progress in attaining those targets, those sustainability targets. They have to do with gender equity, they have to do with environmental issues, they have to do with governance issues, and also with social issues. And only if we see sufficient progress in the attainment of those key performance indicators will those companies remain investable for us. So that means we're moving away from strict exclusion, and we're moving towards an enhancement and a fostering of this transformation of our economies, which I believe is absolutely necessary for us to reach the goals that as a society we're committed to in reaching the Paris Climate Accord and other aspects of the ESG agenda.
Thank you very much, Christian. Lars, we've heard there the development of a pretty sophisticated system of deciding on what gets invested where over at Union Invest. How are you treating this up in Copenhagen?
I could say from our perspective, it's probably a bit of a different approach than an asset manager as Union Investment is doing. But you can say we started out back in 2017 building up our green bond portfolio, and that is invested in the SSA space in Euro and DKK. And one of the key findings that we had very early in the process that there was if we want to really align what's behind the bonds that we're investing in, what are the projects behind, what kind of transparency can we get from the issuers, we quickly realized that we needed to do quite a lot of that job ourselves actually. So we have started a very active dialogue with a few selected issuers that is data driven, that we ask the issuers on the projects behind, how much transparency can we get, how good is the impact reporting on the different issuers. So we gathered this small team from the investment side and from the ESG side, working together on this, actually trying to define what we here in ETP think is green.
Okay, thank you. We've unfortunately we've run out of time. Sorry, we didn't have more time to go into these incredibly important issues. I think we've learned there's a huge amount more issuance taking place, but investors have a great deal more work to do than they had in the past, absent a common ratings set of ratings for these types of securities. So thank you all very much for joining me and my panelists. I'm very grateful that you could join us today. A very useful, quick tour of the themes. So I hope you enjoy the rest of your day. And it sounds like great progress is being made for sustainable capital markets. So thank you all very much. Enjoy the rest of the session.
Good morning, everyone. My name is Hortense Bioy. I'm Director of Sustainability Research for Morningstar for the EMEA and APAC regions. Welcome to this second roundtable, the EU Sustainable Finance Action Plan 2020, a year in review. To discuss this topic, I'm joined by 4 experts. Professor Dr. Martin Helmisch, who is Partner and Managing Director at Deloitte Analytics. Professor Laurent Lascaux, Professor in Economics of Climate Change at Paris Dauphine University. Christian Heller, CEO of Value Balancing Alliance. And Dr. Philippe Nimmermann, State Secretary in the Ministry for Economic Affairs, Energy, Transport and Housing in the state of Hessen. Welcome, gentlemen. So to kick this off and set the scene, let me give you a brief introduction about the EU Action Plan. Unveiled by the European Commission in 2018, the Action Plan is a roadmap to raise the role of finance and investment in achieving a sustainable economy. It is based on the recommendations of the EU High-Level Expert Group on Sustainable Finance, a group of 20 senior experts from civil society, the financial sector, and academia, set up in 2016. The action plan has 3 key objectives: reorient capital flows towards sustainable investment in order to achieve a sustainable economy, manage financial risks stemming from climate change, environmental degradation, and social issues. And the third objective is to foster transparency and long-termism in financial and economic activity. To implement the action plan, the European Commission set up a dedicated technical expert group, which has defined guidelines covering 4 key areas: the taxonomy, benchmarks, disclosure, and MiFID II IDD. With that, let's kick off the discussion, and I am going to turn first to Laurent Lascaux. Laurent, so the title of this roundtable is 2020, a year in review. So what have been the key events relating to the EU Action Plan this year, according to you?
Well, just before starting, and to put things in perspective, we are exactly 5 years after the Paris Agreement, which obtained an agreement from many countries, from most of countries in the world, to adapt our societies to climate change, to mitigate the climate change, and to help financial flows to go to sustainable activities. It's very important to keep this in mind and to keep the objective in mind, because currently we are more on a track to 4 degrees beyond the end of the century, where we know that the economy should not be resilient to more than 2 degrees. And that's very important to keep this in mind, because sometimes when we speak of sustainable finance, we become very technical very soon, but it's important to keep the big picture, I believe. So just to remind that. The second thing, as far as sustainable finance is concerned in Europe, as you know, originally the EU Action Plan was released in 2018. And 2020 was, from this perspective, an important one, even if we don't speak of COVID breakout. It was an important one because there was this project to renew sustainable finance policies by launching a consultation, and the European Commission launched a consultation at spring to know in which direction we should go on these issues. And also we had this COVID breakout, which changed many things in the landscape. To summarize, I would centralize, yes, the activities around this consultation, and with mainly in the three issues you mentioned: reorient capital flows, manage financial risks, and foster transparency. I would focus on two important areas which evolved this year. The first one is the area of taxonomy, and I believe we will have the opportunity to talk about that. A few days ago, the European Commission released its delegated act on mitigation and adaptation. And here, again, I want to put things in perspective. We have a big objective, which is the 2-degree objective, and then the neutral economy in 2050. This is the big objective. And we create some very complicated regulations to deal with this objective. Just to give you an element on that, the last delegated act on technical screening criteria linked to taxonomy make 232 pages on mitigation and 280 pages on adaptation, just to give you an idea of the enormous amount of regulations which are produced by our institutions. So this is the taxonomy part. The other part is the disclosure part. As you know, a consultation has been launched this year on the renovation of a non-financial reporting directive, to take into account also the recommendations of the task force on climate disclosures. So I would summarize to these two objectives, plus the fact that we had to deal with the COVID breakout this year, which means many amendments to the Green Deal project and to the Green Deal investment plan project. So to give you the broad idea on the landscape, I would summarize like that.
Okay, thank you very much, Laurent. Christian, do you agree with Laurent? Are there other events relating to the EU action plan this year that you think are also worth highlighting?
So I think Laurent really mentioned the two key drivers and the two key initiatives within the European Commission. So this is all about the taxonomy and the further development of the taxonomy. And this is also about the non-financial reporting directive, which is currently also in discussion within the EFRAG task force. So this will be the two key drivers. Nevertheless, there are a few other initiatives going on within the EU Commission who are feeding into this one. For example, when we are talking about the digitalization and disclosure of non-financial information, this will also impact in the end the work what companies needs to do, what financial market players needs to do. But the NFRD and the taxonomy for sure are the two key initiatives we need to focus on.
Mm-hmm. So, Philippe, what's the current state of the implementation of the EU taxonomy from where you stand?
I think we are approaching or achieving quite a bit now. What we're doing here in Hessen is, together with our Green and Sustainable Finance Cluster, which is a platform founded by the state of Hessen together with Deutsche Börse and many other stakeholders here in the Frankfurt Financial Center, we're trying to foster the definition of the taxonomy by sending experts into the expert groups, and also by trying to understand what the conclusions of this taxonomy is. For example, that our cluster did work on a handout which tried to simplify a bit the language, because I don't know how many pages are written down in this taxonomy and makes it quite difficult to implement. We're trying to simplify it a bit into, I think it's a 40-50 page paper. People have been written there to help the asset managers, the risk managers, and all the other ones in the community to apply those ones. I think that's the first important step. But the next step will be to widen the taxonomy to other aspects of sustainability. It's not just about climate change. That's very, very important. But I think the COVID-19 crisis did show us in a probably very brutal manner that the social aspects, the social context, social distancing, the quality of everything our society has to offer is very much the S within the ESG. And it is very difficult to implement that, but the next step would be to try to implement that as well, to find a definition. And then I think we have to, because the world gets more and more complicated. I think the pandemic and the climate change just actually did show us that everything is connected in those complex, non-linear, non-tribal systems where there are tipping points. And once you reach the tipping points, it is almost impossible to control the situation anymore. So there are similarities. I think that this approach, how to handle this extreme uncertainty of complex systems, we have to find a way how to implement those challenges easier. And I think we need to take every technology which is already existing or develop it, for example, artificial intelligence, to close the gaps within the ESG data framework, because it's still too complicated. And then the long-term aim must be to change the short-term view, which is still currently very much the way financial markets, but also non-financial corporates look at the situation, change it into a long-term approach. I think long-term is the actual goal of sustainability, and integrate everything within the risk framework. But there's a long way to go, but nevertheless, I think we are actually approaching our aim quite good. I think this discussion, perhaps we are going to have that one later on as well. Is it the right time to implement all those things now? Because there's lots of other problems, COVID-19 and unemployment and whatsoever. Or is it actually the best time to implement? Because if we're able to approach one risk which we already defined, it would be, I think, in my logic, really bad if not tackling this problem now, just because we've got other problems as well. Actually, by tackling this problem, we learn how to tackle other uncertainty problems as well.
Yeah, you touched on many points there, Philip, that we will probably elaborate on later on. But I'd like to ask Martin maybe to focus now on really the challenges for the financial services industry and particularly asset managers.
Yeah, this is a very important point, because that is a question we are receiving very often from our clients. I'm just coming back right now from an audit pitch I had in a large German bank. And the question was, how do you looking from the point of view of an auditor that we are fulfilling in the future these regulatory requirements, these large framework? What can be a realistic view on that? And from that point, we had, even it's focused on banks, not on asset managers, but there are some very important statements. We have from the November this year, we got from the ECB the guidance to climate risk. And here are some very, very important statements. The ECB has made a survey to European banks. It's representative that way that 44% of total assets of banks in the Eurozone have been represented here. So large banks normally with more capabilities than smaller institutions. And the answer was, first of all, one important statement was that the majority of financial institutions today is not able to measure the impact of climate risk to their business model or to important balance sheet positions. One thing. Another important statement was that as of today, we do not have the data available in order to fulfill all the requirements, especially integrating climate risk in relevant risk factors. But on the other hand, the ECB mentioned what is a very realistic view. They said financial institutions, they have to disclose which data gap they do have as of today, and which data they would need to fulfill all the requirements, and what will be the way in the future, a path to close these gap. So from that point of view, it's a very realistic view. It's very clear. We are starting with a regulatory framework which puts in the EU action plan the financial institutions really in the center. The important thing is to bypass cash flows into sustainable investments. So there are a lot of requirements in the financial industry. As of today, it's very clear. There are many difficulties, many challenges to fulfill that. But the important point is that we find a way of an evolution that the financial institutions will be able to fulfill these requirements in the future.
Mm-hmm. And Christian, you recently became a member of the European Commission's platform on sustainable finance. And this is a platform that advises the European Commission on the implementation of the taxonomy regulation. What are your current observations, and how can the data gap that we've just talked about be overcome?
So I think,
according to you,
yeah, I can easily build on Philip's and Martin's comments. So first of all, yes, climate is the first part, but it's not exhaustive. So we need to have a look not just at the complete environmental area, but we also need to include social and human aspects, including the financials. And what I'm highly concerned about, if you're looking at the current framework of the taxonomy, just talking about climate risks and mitigations, it's so detailed that not just the banks, also the real economy has really challenges to get the data provided to the asset managers or to the financial market in general. And I think we need to look for solutions how we can close these data gaps. And I'm not sure if assumptions are sufficient, because in the end, you need to audit the data you're providing to the external audiences. And here I think there's much work to be done within the Platform for Sustainable Finance, not to overwhelm in the end first of all, the financial market players, but also the real economy, because the request will directly go to the real economy. And here we definitely need to think about more pragmatic solutions, how the data can be provided in the end. Because overall, the direction the taxonomy is heading for, I think, is the right way to go. We just need to find solutions which are feasible for all of us.
So, for example, do you think companies should use existing data that are similar to the data that is requested by the taxonomy? And if that's the case, can you give an example?
So when you're looking at the data which corporates are disclosing around greenhouse gas emissions, this should be the core also to feed into the taxonomy and the taxonomy regulations. The challenge is that the taxonomy is going in so much details, talking about business activities, talking about definitions with regard to CapEx and OpEx, where first of all, this detailed level of data requirements are currently not within the corporate data systems, so you can't fulfill these requirements. And secondly, corporates will ask the question, should I really disclose data on CapEx or OpEx decisions to the external audience? Because here we also have quite some competitive intelligence in. So these are questions where I'm afraid that we raise quite some opposition from the corporate sector if we're going this path in these details.
Philip, do you agree with that? Do you think that there's only so much that companies can disclose anyway?
It is an important
in terms of,
issue.
in terms of CapEx and OpEx, it's not probably a good idea for companies to go down that route.
I think transparency is very important, because transparency is the beginning of awareness and the beginning of responsibility. So I'm very much in favor for transparency on certain issues. I think it's always the question: what is necessary to publish in public, or do you just give it to the regulators and the supervisors? Normally, most data is just given to the supervisors. So I would understand if, especially non-financial corporates, are not willing to give up all their information. I don't think that is the most important point. I think it would be what we are trying to do in Frankfurt, for example. We're trying to build a big financial data cluster where we would like to collect all the regulatory and supervisory data which already exists. We are supervisors for the Deutsche Börse, for example, and there's the BaFin and the ECB and Bundesbank, and together with other private companies and academia to form this, I'd say, very safe big data cluster and cloud to make it easier to identify all the relationships, the interaction between the macro world, between individual company data, real economy, financial companies, to make it easier to apply all those ESG relevant measurements. I think that is to make it more simple at the end of the day. At the moment, I think everything is very much complicated, I think, the way it's structured. And I think within a very secure framework, it should be possible to publish all those data if you make sure that the competitor doesn't get the data, because I think then it would be an unfair advantage. But I think you have to put it down to a specific point within the financial reporting where it says this is too delicate to publish, and perhaps one can anonymize it in one way or another. But I think that has to be sorted out by those experts who are really specialists on financial reporting.
Mm-hmm. Laura, maybe you can add to this, because at the end of the day, we can imagine that investors would want to know this type of information. So there is kind of a balance, I guess, to find between providing enough information to investors so that they can make informed decisions, but also not revealing too much for fear of being, of a competitive disadvantage.
Well, I will not answer directly to your question, but I would like to mention the fact that yes, what is created is a very complicated approach. I repeat, the delegated act published, the draft published a few days ago, makes with the two annexes more than 500 pages, and it's obviously. It implies many data to be collected, that's right. And despite of this approach, you only deal with the sustainable part of the activities. And the transition is not only a question of a sustainable part. You have an important role to be played by transitioning and enabling activities during the years to come to switch to a decarbonized economy. And the feeling I have, despite this many pages I mentioned, the feeling I have is that we only deal with a very green approach, okay? But we don't deal with the brown part of the economy. Reorient capital flows towards sustainable activities, towards sustainable investments. It means also to shift it away from unsustainable financing. And so we have many data to collect just to deal with a small portion of the activities of our economy. I don't know whether I'm clear, but I want to insist on that. And the way to answer this dilemma, I would say, or this question, is the other part of what we talked about sooner in this discussion. It's the disclosure part. I mean, through a transparent disclosure by companies, you can deal with this enabling or these transitioning activities, because you can ask to the companies to report how they deal with the transition. On the data, I have nothing to add to what has been said, actually, to be honest. That's already we created very complicated things just to deal with the sustainable activities. And the challenge beyond that are still enormous, I would say.
And Martin, maybe you could add to that this balance that companies need to find between disclosure and disclosing enough, but not too much.
Yeah, but before I do that, I want to highlight that point Philip mentioned about the financial big data cluster. Because what we are seeing when we are focusing on that regulatory framework around climate mitigation and climate change, we are seeing that it's really a big data problem. At the end, we do not need only sustainability data like CO2 intensities and others. What we need to do to solve that problem, very simple question. How can a bank quantify today that the future credit spread of a company with high CO2 intensity will widen in a situation when political changes around climate change will be in front of us? It means we need to connect these data like CO2 intensity, with fundamental data about the company, the business model about the company. We need to link that to macroeconomic figures, etc. So it means we need a lot of data from different sources to combine these data and to draw conclusions out of that data. And this is definitely something which cannot a single company solve with own resources and their own responsibility. This is something where we need an initiative which brings different players in the market of different kind together. So we need an initiative where you have data provider on board, where you have financial institutions on board, where you have academic institutions on board being able to provide the right models, where you need technical experts, how to organize the data, how to set up data platforms, how to combine this data with methods from machine learning, artificial intelligence. And that is something what the financial data cluster, big data cluster provides. And I think this will be the way how to solve that problem in the future. Of course, on the other hand, as we know, as of today, many sustainability data, being the underlying at least of a part of the relevant data, are estimated in the original data. So, and that is the question you had, how can we motivate corporates to provide us with the data? I think there are two ways, of course. One thing is to have here the regulatory framework in place, which may more or less enforce corporates to do so. But on the other hand, more and more, this will be a competitive factor. I do believe more and more, step by step, the public attention about the behavior of corporates related to sustainability is changing more and more. And I think definitely one important point is disclosure, of course, which creates confidence. And what we can already see today in academic papers when we are doing statistics about behavior of credit spreads, about costs of equity, cost of debt, we can see that in Europe already the market has recognized that companies with a reliable disclosure have advantages here. In the United States, statistics show different figures here or different outcomes. But maybe this will change now when the government in the US will change. But at least in Europe, we can see disclosure is an advantage for companies. It ends up with a chance to have lower cost of equity and lower cost of debt. At the end of the day, hopefully soon, the financial market and the incentives from financial markets will regulate this.
Mm-hmm. And a question, I mean, are you already seeing efforts from the regulator to simplify the requirements for implementing the taxonomy?
So maybe I'm building on a few comments before touching your question or answering your question. So I think what Laurent mentioned is so important because when you're looking at the taxonomy, there is really the concern that the industries who are currently creating the most CO2 emissions are separated from further investments from the financial market because in the end, we are the ones who are not taxonomy compliant. And here we need to look and to reallocate capitals into the brown sectors because here we have the emissions. These are the sections or the sectors we need to transition. It's not the green ones. It's not wind energy and something like this. We are already providing their contributions. So we need to go to the overall heavy industries and to the heavy energy sectors. The second one, what was just mentioned by Martin, yes, also in the platform of sustainable finance, it's highly discussed how we get the data in and how we can work with assumptions because many of the data are missing. So all collaborations which were just mentioned, for example, within Frankfurt with the sustainable finance cluster, are so important because as of today, many corporates are already trying out to work with this big data systems, how they can close the gaps, how they can measure in this case, their CO2 emissions along the complete value chain. And especially when we are talking about climate change, it's not just about your own operations. If you're thinking about climate change impacts of a company, you need to take the complete value chain into account, from sourcing, own operations, but also the downstream effects. Coming back to your question, do I see currently ambitions or efforts by the Commission to reduce the complexity? Unfortunately, not yet. But I think the first discussions have really started to interconnect the different work streams within DG FISMA and the EU Commission in general. So looking how the NFRD, for example, links to the taxonomy, where do we have overlaps? And all the work which is done also by the EFRAG task force, how is this feeding in to simplify things and to simplify requirements in the end for the financial market players and for the real economy? Not sure how far we get there, but we need to do this rather urgently, because otherwise these really good initiatives might fail.
I mean, there are already a number of companies that are disclosing, that are using the TCFD framework to disclose. I mean, how does the EU taxonomy fit into that framework? Maybe Christian, you want to?
So you have, not just talking about the TCFD, you have many frameworks currently coming up at the international level, also at the regional level. So the EU is currently highly focused on the NFRD and on the taxonomy. Yes, you have the TCFD, you have, for example, within the World Economic Forum, a metrics in place. There are also other initiatives like the work we are doing in the Value Balancing Alliance to provide methodologies how you can create data in a more standardized way, because in the end, the investors or the financial market in general needs to compare results of the performance of companies, so standardized methodologies will be key. Currently, it's not sure in the end what are the best and the most easy methodologies to be applied. Therefore, we would definitely advocate for international solutions. And you see this already upcoming with the most recent statements by the standard setters like IRC and ZESP are now merging, and you see that there's a huge collaboration going on, including GRI, CDSP and CDP. Also, the IFRS will play a major role setting in the end the framework for non-financial information when you're looking at the latest consultation paper to set up a sustainability standards board. So there are many initiatives, and the key will be that these initiatives are now starting really to discuss in detail what are the best solutions. And here, not just the financial market, also politicians, also civil society, and also the corporate world needs to step in to, in the end, meet the needs of all of the different players.
And Philip, do you know how long this is going to take? Because that's a lot of collaboration in a climate that, as you mentioned, you know, is maybe unfavorable with the COVID crisis.
Well, we as a state government are not directly involved in those negotiations, but we have via our sustainability cluster experts who are also in the sustainability platform of the EU. I think at the end of the day, we have to live with a world where we cannot define everything. I don't think we'll reach a point where everything can be defined 100% and automatically by whatever system find out how either the transition takes part or how the KPIs are being reached. So we have to live with uncertainty, even with the taxonomy, I think. So there's more to do than just defining taxonomy. And if there will be areas of not being undefined areas, it's also, I think, a matter of how the attitude of the companies are. I think we need to change, or not to change, to try to foster an attitude towards sustainability. Because at the end of the day, we cannot simply rely on all those indicators. And it will be impossible in this world. I don't think we'll ever reach that point to find every sustainability aspect in a single indicator with one rating. At the end of the day, it would actually be interesting if using big data, a combination of macro data, micro data, non-structural data, whatever data, to implement sustainability into the business model and into the risk assessment of a business model. However it comes out, I think that is should be the ultimate aim, that you don't only have, if you look for credit rating for a company or a business model, that this automatically integrates sustainability aspects. And I think you won't be able to do it on a one-on-one single indicator basis. And I don't think a model with 1,000 indicators is better than a model with 50 indicators. I think it's actually over-determined if you use too many indicators. So we need some sort of reduction of complexity, although we do know that the world is very complex. That is our challenge, and that is not a dilemma, but that's how the world is. So I think change of attitude is also important, as well as working on all those indicators. I don't know how long it will take. I think it should take, we should speed up. And one way to speed up is actually increase, I said, macro regulation. For example, Germany, I think we're starting with, I think, not very ambitious carbon dioxide price next year. If it would be to at least my party, it would be much higher, because if you change prices, things speed up. That's where the government got their compromise, but not very ambitious. At least we're starting next year. So we can do something as politicians to speed things up, while in the form of change in the broader macroeconomic regulatory framework, but also in talking a lot about this issue and trying to change the behavioral attitudes.
And Martin, then what would be your advice to asset managers? I know there are a few listening. What can they do to help the situation? We talked about, how they can engage with investee companies, how they can engage also with data providers. What can they do?
No, the key point is when we are talking with our clients, and we have several big asset managers in our client base. Many asset managers are seeing also this topic as a chance to differentiate from from competitors. And then the question is from that asset managers, how we can implement EU taxonomy, EU disclosure regulation, that way that we are doing it better than our clients. Of course, there are many ways to attack this problem. Of course, the question is new product ideas, impact funds, asset selection. So the whole investment process is, of course, the question how climate risk is translated to that. But also here we are coming always to the same point. When we are setting up project with asset managers, what we are doing at the moment, the target of the project is then implementation of the EU taxonomy, implementation of EU disclosure regulation. At some point of the project, we are coming back to our initial discussion point, the request for data. It's always the gap at the moment. And when I think about the big picture in financial institutions, I always remember to a point which is comparable to that. Financial institutions, typically, they have core competence in managing market risk. They have core competence in managing credit risk. In the past, financial institutions always had difficulties, for example, to manage operational risk, because operational risk is more the core competence of insurance companies than of banks. So what happens now, the request to asset managers and also to banks, not only to asset managers, is to become really a competence center for climate risk or bigger picture ESG risk. It's very clear this is not a point they can reach as of now. It's an evolution, but it's very clear. We will not be able to solve all the problems in a very short time period, even we have a big time pressure. But it's very clear, investment managers, they have to think about a strategy, how they can become really competence centers in that area. When we are looking to the current ECB guideline, it's more for banks, but in parts we can translate it also expectations like this to asset managers. One of the requests is to take into account the absolute newest academic papers about the development of climate risk, to take this into account into investment decisions, take this into account in product structuring, take this into account in how to manage different kind of risks. So this is between the lines. This is a request to financial institutions to become competence centers here. And it's also, by the way, very logical, because the EU Action Plan puts the financial industry into the center, and which means asset managers and also banks, they have to take that into their business plans, how we can become competence centers here on the middle run.
Laurent, you mentioned brown activities, and you said that obviously we need to have more capital flowing into companies that need money to transition. At the same time, when you look at the products that are offered to investors, or when or retail investors, or when you talk to retail investors, they have their own idea of what sustainable is, and they often don't like to see some brown brown companies in the portfolio. So how can you deal with that? It seems that retail investors are not necessarily willing to finance those activities. I mean, to help transition those activities, or there may be some education work to do there.
Well, many things have been said. I'm going to answer your question, Hortense. But first, I would like to elaborate on different things which have been said. First, like Martin, I think that it's right. Financial institutions are better at managing credit risk and market risks than operational risk, and obviously climate risk. And there is a need of knowledge to be developed there. That's very clear. Again, I repeat, we are on track to 4 degrees, where we should be on a path to 2 degrees. So there is an urgency, and obviously financial institutions have a big role to play there. Second remarks on what Philippe and Christian said about complexity. In 1988, you have a US anthropologist and historian, whose name is Joseph Tainter, who wrote a book titled The Collapse of Complex Societies. And one of his conclusions is that investing in complexity as a means of solving problems always end up reaching a point where the returns are diminishing. That's his conclusion. And that's a danger we have to deal with on these issues, which is to try to avoid as much as possible to go to too much complexity. And so I agree with what Christian and Philippe said behind the headlines on that. To answer your question, Hortense, on Brown and on the fact that investors perfectly know that what they want. The sustainable finance policy in Europe has been developed starting from the Capital Markets Union project, if you remember. And so it has been approached, I think, mainly from a financial markets perspective. And when I speak of brown activities, I have in mind banking sector more, because it's possible to develop sustainable products on the financial market side, but on the banking side, you have a balance sheet to deal with, and in this balance sheet, and you have also some customers to follow in their transition, and in these customers, you have plenty of people who have business model completely built on fossil energy use. And so that's why probably because I am an ex-banker, I have this bias to say and to insist on the fact that we have to deal with these people who have the business model based on carbon intensive activities. And that's why that on the investment side, people who make sustainable investment perfectly know what they want. And from this perspective, the taxonomy is an answer. But it's not an answer to deal with the real challenge, which is the general transition of the economy. I hope to be clear, but that's very important in my mind.
Maybe at this point, it's also, thank you, Laurent, helpful also to mention the fact that, obviously there is the EU taxonomy, but the momentum behind the EU taxonomy has trigger the creation of many more taxonomies in many other jurisdictions. And presumably investors don't want to have to deal with 50 different versions of what a taxonomy should look like. So are there plans for international coordination to harmonize taxonomies? Who would like to take this one?
So maybe I'm kicking this off. You see that within the EU Commission, we have also established a group which is looking at an international finance and an international taxonomy. So this linked to the processes I mentioned before with regard to the international standardization of reporting frameworks. I think there's really a way forward how we can come to a global agreement, because this is in the end for all of the asset managers, but also for the real economy who are working in global value chains on global markets, essential that we're getting a global framework in place. Otherwise, you will drive all of these actors crazy because we need to report on totally different standards. So the international solution is key. What we also should recognize, and we were talking quite a lot about the challenges as of today. We are in a really huge transition of the economy from a more industrialized economy to an intangible and digitalized economy. And we are currently following with all the work what we are doing, this huge transition which is ongoing. And it's so important and it's so promising that we are now talking about each other, that we are trying to find solutions. So we should not just talk about the challenges, we also should look positively into the future. There is movement, the different actors are working with each other, talking to each other, finding solutions. So this should give us hope that along also the Green Deal within the EU, we will find ways how we really transition the economy in a meaningful way.
But there are also competing interests, right? When you look at China or Canada, they have a different economy. So this is going to take a long time, though. I just want to go back to this question that I asked Philippe earlier, like how long is this going to take?
So let me add maybe one point to that. Looking back to the younger past, when we discussed about global harmonization of regulatory rules, for example, the discussion around implementation of Basel IV. It was always a very, very big issue. And of course, different countries have contradicting targets here. That was related to the discussions between the Euro area and the United States about specific rules in Basel IV. And of course, this will be also when we're thinking about a global harmonization of taxonomy, because different countries, they want to protect different kind of industries. And of course, they want to optimize then a disclosure rule. So I share the opinion it's extremely important. If we report on different standards, then we are opening the door for something which has traditionally the name regulatory arbitrage. So we need, of course, to avoid that. But the way to establish something which is harmonized will be a very difficult way. And I do not expect the short-term success here, even if we would need it.
Mm-hmm. I think we only have like 8 or 9 minutes left. I'd like to talk about the implementation of the FRDR, level 2, with Article 8 and Article 9, which concern financial product level disclosures to be met in respect of light green and dark green financial products. The implementation has been delayed. Martin, can you tell us about this delay and if you think this is a good thing for the asset management industry?
From my point of view, the delay was talking with the asset managers itself. The delay came because the original time horizon was not realistic. So then it comes to the delay. And of course, the delay for the asset managers, of course, it is necessary to prepare on that. On the other side, it's also very clear in the whole transition to a low-carbon industry, we have enormous time pressure. So from that point of view, of course, each delay is a disadvantage. On the other side, we have to be realistic. What we need to do is, of course, to assist financial institutions to be able to fulfill their requirements as fast as possible, to minimize delays in the future. From the current point of view, it was realistic to delay this.
And do you think that now asset managers have a clearer view of which of the products will qualify as Article 8 or Article 9?
I think the view is better now. And also, by the way, there will be the discussion again, what is realistic, what we can create. I think from that point of view, during the now prolonged time phase, we will have the chance to clarify a lot of things.
So, Philippe, what do you look forward to next year? I mean, you mentioned, the importance of focusing on environmental issues, but there are also other issues that we need to be looked into. So, what major steps can we do next year?
Well, with regards to the state of Hessen, and it's already been mentioned, we're working intensely on creating this financial big data cluster, where we'd like to collect all that data mentioned earlier, macro, micro, and other data, to identify challenges with regards to sustainability. It's not just the climate side, it's also market integrity. I think even from the German point of view, coming from a country where Wirecard has its seat, it's also good governance is very important. So we have to find ways of how to find out wrongdoing and non-compliance with regards to money laundering and everything else. So it's very much to do. I think ideally we should make our non-corporates and non-financial corporates and financial corporates, enable them to understand complexity better, to use scenario analysis, perhaps ideally to formulate a digital twin of their company, which one can stress various crises, a pandemic, financial crisis, climate transmission. But there's lots to be done. We're working together with the community. I think that is very important in a corporation. With regards to delaying something, I think it's really important to make it transparent. If you want to delay something on fundamental reasons, because you think climate change is not man-made, or on technical reasons as just explained. I'm very much in favor of allowing a delay if something does not work yet, but not everyone, I think, is that transparent at the moment with regards to their inner attitude towards reaching a more sustainable economy.
And do you think there is a silver lining in the COVID crisis, in the sense that companies now better understand the importance of sustainability and building resilient business models? Like, do you see that?
I think we all have learned a lot in the last, was it 9 months now, 8 months from this crisis. The second, I don't know, call it wave, but the second lockdown already in Germany at the moment, in France and other countries, is much different compared to the first one. And I think once we reach next spring, there should be a silver lining, and we learned a lot about complexity. And I think we should keep that experience and use it for other challenges as well. And I'm very confident that we will come out of this crisis strengthened in the way that we understand the complexity better. At least that I have to be optimistic. I think we are seeing a silver lining, although I can't see it yet, but we should see it next spring, hopefully.
Next spring. Laurent, what would you say about the lessons we will learn from the COVID crisis?
I agree that we learned a lot. The link between biodiversity issues and the birth of this pandemic are not established, and it would be unfair to link clearly the birth of the pandemic to biodiversity issues, even if some scientists say it. But which is clear is that as far as the management of our complex organizations is concerned, and in terms of governance, in terms of resilience, yes, we learned a lot, and clearly the crisis we had to deal with is probably a very good announcement of what could be probably in worse, a true climate crisis. So it's there are many similarities, and yes, we learned a lot. I think that's the case. Yes, we have no delay to deal with. We must act as soon as possible. There is really an urgency.
And Christian, same question to you. Any lesson learned from COVID, or if you want to talk about key events on the regulatory front that we should expect next year?
So I think what COVID makes quite obvious is that the current business models, when we're just looking at profit maximizations, they are not sufficient anymore. Corporates, as well as the whole economy, including the financial market, need to take additional responsibilities into account. And as we always say, you can only manage what you can measure. Yes, we need to have systems in place how you can really measure the impact of the financial market, of global value chains, and all of the aspects we were just talking about. I think what is a really essential indication due to the COVID crisis, the whole discussions what we had over the last years just focusing on climate is not enough. We really need to take the complete environmental topics into account. We also need to look for the social, human and governance part of things. Otherwise, we will still missteer in the end an overall long-term value contribution or resilient business models. Looking at the next months, what will come, especially also driven from the EU Commission, I think it's highly essential that the tech is looking much more into the other environmental indicators, but keep it on, let's say, a level of detail which is manageable by all of the different actors in the economy. Secondly, the work what the Task Force on Sustainable Finance will do on social thresholds will be also essential to feed this in, because as we see with COVID, everything in the end is highly interconnected, and we need to have as comprehensive picture as possible on all of the different effects and impacts.
Okay, thank you very much. This is all we have time for. Thank you for this very insightful conversation. And thank you to my panelists, Professor Dr. Martin Helmisch, Professor Laurent Lascaux, Christian Heller, and Dr. Philippe Nimmermann. And I hope you enjoyed the rest of the event. Thank you very much.
Well, thank you very much, well, good morning to all of you in London, I think, and well, good day to all of us who are now on the panel for the third session. It's a pleasure, my pleasure, to introduce the next session by presenting to you the Council of Europe Development. I'm Rolf Wenzel. I'm the governor of that institution. In other institution, you would just call it the president. Now, I would like to give you a little bit of a background
first of all, for the institution, but also as a starting point for the discussion that we are going to have moderated by Danae. She will come in later. But just to talk a little bit about the Council of Europe Development Bank, or as we call it, CEB. We have been set up in 1956, so that actually makes us the oldest European financial development institution. I like to stress that we are sometimes a little bit overlooked. I'm looking at the colleague from the IFC, the office here in Europe. I'm also having in mind colleagues from the European Investment Bank or the European Bank for Reconstruction and Development Bank. But we have a very distinctive mandate from our colleagues in the EIB or EBRD. We have a social mandate. Our mandate given to us when we were set up in 1956 by our 8 founding member countries, our mandate was to promote social cohesion within our member countries and across member countries. We were set up in 1956 by 8 Western European countries. We expanded over the years, over the decades, our membership. And today we have a membership of 42 countries. All of them are European countries because according to our statutes, only European countries can join the bank. And what is important for our solidity, our functioning, our visibility, if you like, is that we only can lend to our member countries, and all of them are European countries. Now, why is it so important to have a social mandate? Well, we are the only one. We are very focused and a very narrow mandate, if you like, to promote social infrastructure investment. At the time of our establishment in 1956, we still had, when you looked at European cities, there were still moving out, recovering from the aftermath of World War II. We had a lot of displaced persons, a lot of refugees in many European countries. So our mandate at that time meant to restore, rehabilitate social infrastructure, like setting up hospitals, creating social housing facilities, and so on. So clearly understood in 1956, that was the need and that was our objective. And we were the first multilateral European Development Bank in place at that time. Now, over the years, our mandate was not changed. It's still to promote social cohesion. But of course, given the developments in Europe, we had seen refugees coming after the breakdown of the former Yugoslav and the emergence of new countries joining the EU. We have seen in 2015 a surge in the number of refugees and migrants arriving from Syria, Iraq, Afghanistan, and other countries in Europe. And again, there was a huge need for our institution to come in and to support the countries that were receiving the refugees and migrants who needed social infrastructures, affordable or social housing, if you like, schools, and so on. Now, since March this year, we have been engaged, obviously, in supporting our member countries with financing additional projects, investments in hospitals, turning hospitals into intensive care units, buying protective suits, respirators, hiring and paying nurses and doctors for hospitals just to cope and help our countries, our member countries, to cope with the COVID-19 pandemic. Now, how do we finance ourselves? To talk about now the financial side. Well, like so many other, and I think almost all international financial institutions, IFIs, we issue bonds. And normally you would could argue that a social development bank that issues bond, any bond should be a social bond, which is good news for investors who are interested in investing in social infrastructure projects by buying our bonds. But of course, we realized that there was a lot of, first of all, investors were hesitating because they didn't know whether the bond was really a social bond that we issued, because they had this experience of the greenwashing. Buying a green bond and you never knew whether that bond is the proceeds from the bonds are really used to finance green projects. Investors were a little skeptical. So we were happy to see that the International Capital Market Association, starting in 2015, moved into the establishment, agreeing between investors, institutions, and let's say stakeholders to develop principles and eventually agreeing on guidelines, what could be called a social bond, and then also a green bond. So we have today well-established guidelines for what could be called a social bond and a green bond. Now, for us, it was important to have these guidelines in place because our point was saying, we are a social development bank. Any bond that we issue is social, but there was skepticism, hesitation on the part of investors. The new guidelines coming into effect 2016 enabled us, starting in 2017, to issue what we called social inclusion bond. And I think we really met a strong demand. We saw the financial market segment that was interested in social bonds was really very interested, and it was a growing market, a growing market. And of course, as an international financial institution that is going to the market to raise the capital that you need to finance your projects, you want to have an investor base as broad as possible. So we really wanted to tap that growing part of the financial market by offering the right product, a social inclusion bond. And we said to investors, look, we are very transparent. You know, we are a social development bank, but we will tell you exactly what is going to happen with the proceeds of the bond that we issue. We will, first of all, invite an external rating agency to rate the projects and to monitor the project that we finance with the proceeds of the bond. And 1 year after the issuance of a bond, we will release a report, what we call an impact report. So that was in 2017. We also asked the ESG rating agencies, and in our case, it was Sustainalytics, to have a look at our framework of social inclusion bond framework. So to give additional credibility to our undertaking and giving assurances to the investors that the whole framework is really fully in line with the guidelines and the principles developed by International Capital Market Association, ICMA. We started in 2017, with the first issuance of a social inclusion bond. And every year after 2017, we continued around end of March, early April to issue a social inclusion bond. This year, we really saw a surge in the demand for social bond. Obviously, this is a welcome development for a social development bank to see this interest, this growing interest in the market because of what? Because of the growing need for social investment. People are starting now to talk more about inequality and the societies, and that would breed, let's say, people being, well, not being able to find affordable housing. That creates tension for the social fabric of our society. So investment in these areas, social housing, education, energy efficiency, was very much something that investors wanted to support. Maybe we can talk later a little bit about regional differences, interest in Europe as opposed to interest in Asia and North America. We saw that some investors in Asia were less interested, but that has changed, we believe, in the course of this year. In 2020, this year, when we again went to the markets to issue a social inclusion bond, we actually called it COVID social inclusion bond, because ICMA broadened its framework and allowed us to finance with the proceeds from the issuance of that bond also COVID-related projects. And that was, of course, a very welcome move. We saw a very strong demand again for our bond. And we believe that the social bonds are now clearly established. There's a strong demand. We will see it also when the European Commission comes to the market with their programs, the EU recovery plan. I guess we will see a strong demand. All the more important, this is our impression, our our experience is to have a strong framework in place, what actually can be called social. So please, no social washing here. It has to be very transparent to be credible for investors who want to invest, who set up special funds to invest in social bonds. Now, if you finance projects, you cannot do it without also having the E of the ESG in mind. You cannot just finance a social housing for low-income families, a social housing project. You have to do it also in a way that it protects and meets certain environmental standards. So for us, this is also very important to marry, if you like, the E and the S. The environmental and the social component have to go together. For us, there is no difference. There cannot be any difference if you finance projects, be it social housing, hospitals, public buildings, infrastructure. It has to be the two elements, the two components of the ESG framework have to come together. A last word on our institution. I think for any public institution, and we had perhaps a bumpy start when I look at the IFI landscape, but we started very early on to be interested in having a rating for us as an institution. What are we doing? How are we operating internally? How conscious, how sensitive are we, how we use our resources as an institution? And we are quite happy to see that we have very good ratings, for example, from Sustainalytics, who is looking at the ESG and rates us. And I think this is becoming more and more of interest for investors, not only what you do, but how do you behave as an institution. So far for me, from my side, for our experience, Council of Europe Development Bank, and well, thank you. Maybe we can then start with the panel discussion. Unless there are any other questions from colleagues at this point.
Thank you, Dr. Wenzel. That's very interesting. And also how you said that the E and the S are very well and closely linked. That's something I think that we look forward to discussing in the panel, and also the discussion around certification and avoiding greenwashing and social washing. I thought it was really interesting what you said, that the demand was there, that your institution was by definition issuing social bonds, but there was still not that trust for investors. And that lets us move on to our next speaker, Jan van Bilsen from the IFC. The IFC is, of course, very involved in this area as well. And from an issuer's perspective, it's interesting to hear from your side, what do you see as the benefits for issuers? Why go into all this trouble that Governor Wenzel was describing of kind of countering suspicions of social washing or greenwashing? Getting the certification is quite complex, sometimes expensive to do that. Why would an issuer go through that? Is it for investors as well? Is it that ESG products outperform? What are the dynamics there? And also tell us a little bit about the work that the IFC has done in this area. You've partnered with big asset managers, with Amundi, for example, both in the area of social, of green. And as a big multilateral organization, you are very much ahead in this. When we look at the issuance volumes, the multilateral development banks are very much ahead when compared to, say, sovereign issuers. So tell us a little bit about that. Thank you.
Well, thank you very much. First of all, the pleasure to be here. And with here, I mean, of course, at this one table, but also here at Frankfurt. Would have loved to join in the studio, but due to strict COVID measurements, we have the World Bank Group that I basically work for the office. And apologies for some background noise. It just started right now. Somebody else in the building here. Yeah, first of all, as neat as IFC, IFC, we consider ourselves a front runner when it comes to sustainable finance. Basically, I think it's fair to say that everything we do is sustainable finance. Actually, we were also set up in the same year as CEB in 1956, as part of the World Bank Group, focusing purely on the private sector. And to give you some examples of where we have been a front runner in terms of ESG is basically in terms of the performance standards that IFC, the World Bank Group, developed already a number of decades back. We strongly believe that there is a positive correlation between proper E&S and corporate governance as well, management, and the financial performance of companies. So I think it's fair to say it started off with risk management a number of decades ago. The example of the Yanacocha mine in Latin America is a good one, where there was a mercury spill, the population picked it up, it's silver from color, they got ill, and the roads got blocked to the access of the mine, and therefore major issues. So the way that we work is together with NGOs, with CSOs, to make things happen, rather than say, okay, fine, these are challenging projects for ENS, let's turn back. No, we basically need engage with clients, we support clients, and as I just said, with the standards that we indeed have come up with, look at the equator principles, which are now widely adopted for the past 2 decades, also developed by IFC and a few leading product finance banks 20 years ago. This is another example of clearly taking the ENS standards to the forefront. A few other examples are the sustainable banking network that was set up like 6 years ago. Now there are 38 central banks across the world who are members for ESG standards for the financial sector in those countries. And then lately, at the beginning of last year still, in 2019, the impact investing principles. So at the moment, there are 107 parties who have signed up to this. And this is basically to avoid exactly this green washing. And this includes very large parties, just like UBS and Zurich Insurance and BlackRock and others indeed as well. So what I'm saying is that as IFC, we strongly believe in the ESG management. A recent study that we have conducted as IFC to compare companies in our portfolio that have a good ENS scoring as compared to those who don't, also show that they outperform financially. And I think this is probably a turning point that we also see in the market. I think there were more investors who realize that it's not only, from a sustainable or a let's say ethic point of view to say, well, should we join these bonds indeed as an investor? But it's also that the performance of those bonds are generally sort of in par, consistent, and perhaps even slightly better these days. So I think we probably reach indeed the turning point. I think the demand for what we see, the demand is still much higher as the supply. As I see, we are very active as an investor. We have issued over 200 green and social bonds. The first green bond in 2010, the first social bond in 2017. So we see that also ourselves when we issue. We also invest ourselves, and we also assist in the regulatory environment. So therefore, we offer a sort of a one-stop shop. But yes, all in all, indeed, I totally share the views that Dr. Wenzel indeed mentioned, that there needs to be a stronger framework in place. And let's say also indices for social bonds will also help in that sense. Let me just stop there. Happy to.
Thank you. That's very useful, and I think also a good bridge to our next speaker from Deloitte, Martin Helmich. It'd be good to hear from you on the kind of more day-to-day operational challenges of ESG investing. We've heard from an issuer's perspective, the kind of certification questions, the questions around performance, but investors are looking at several strategies when it comes to implementing ESG, and investing in sustainable products such as the bonds we heard about is one of them, but it's not the only one. There's also exclusionary strategies, for example, and that's where social washing and greenwashing comes into mind, but also there may be some assets that are more straightforward in dirty sectors or brown sectors, as some still call them. But at the same time, there may be active ownership strategies of actively engaging with these sectors and helping them transition and looking at the opportunities for that, because that may be where the biggest wins are to be made if you can help such a dirty industry become green or social or sustainable. So how do you see that in your everyday work in terms of working with investors to integrate these strategies, and what do you see the challenges to be? We heard about the kind of monitoring, data, taxonomies, disclosures all come to mind when we think about this. tell us your experience. Thank you.
Yeah, let me start with the big picture. The big picture is at the moment that, and it also, by the way, subject to our discussion here, that we talk about reshaping of financial services in general. And that's, of course, different thing. That's, of course, offering investment products. That's the core topic of asset managers. We are also talking at the same time trading financial products. We are talking about the same time bank lending. All these things at the moment are in a process to become reshaped. And when we discuss about this, what are the operational issues we do have here? First of all, we need to integrate climate risk factors, sustainability factors into the risk management of all these financial services. That means we have to integrate climate risk into the market risk framework. We have to integrate, as even the request when we think about bank lending, then we know when it's also a request, one of the expectations the ECB has published in the November guidelines, that lending decisions, climate risk factors should be implemented into all steps of the whole credit process, which means lending decision, but also then the risk management of important figures like probability of default, loss given defaults behind. We have the same thing, funds, when we set up green funds or impact funds, then we need to manage the rated factors. And this comes all to one important thing. Do we have the framework? Are we able to integrate climate risk factors in investment processes, credit processes, and related risk management frameworks? What are the main challenges today, beside to find the right methodology, beside finding models? We are coming to one core point. The core point at today is with respect of data. Do we have the right data available, and are we able to integrate this data into the frameworks? The point is, this is not the case today. And even the ECB in the publication of November 2020 has made a clear statement about that. We have today very big data gaps. And then the question is, what is realistic? What we can achieve today? The ECB has also published at the same time, we need to identify this data gap. This is the expectation to financial institutions, and we have to close it. And we have to find a way to move forward here. So it's a realistic expectation. It's very clear. We have a huge project, reshaping financial services in general. We have to find innovation path, how to achieve this, and we have to identify what are the gaps. In talking with our clients, of course, we have several projects, for example, where we have the task to implement EU taxonomy. We have other projects to implement EU disclosure regulation. And of course, we have several challenges, but the biggest challenges we have identified at the moment, beside of methodology, is indeed the data gap. To solve this issue, I think we are all affected. Not only the asset managers, not only the banks, also the regulators, even the data providers itself. The way how to solve this in a short time period is to have beside regulation and requests, is to have coordinated actions between different market players, data providers, financial institutions, regulators, to solve this problem very soon in order to be able to measure. We discussed about the topic performance. Are green products, do they have really a better performance? Many publications, many academic papers show indeed, if we compare brown index versus a green index, the green index is outperforming. We have many academic papers with the statement in terms of cost of equity, cost of debt, companies with low CO2 intensity and companies disclosing they have a better performance here. But on the other hand, without reliable and comparable data, it's difficult to measure these. So we have to close the data gap very soon.
Thank you. And the NGFS, the Network for Greening the Financial System that central banks have set up and where OMFIF is a stakeholder member, has just created a work stream on closing data gaps. And actually the first step is to identify what are the data and metrics that institutions use the most, what access they have to them. How can we rely not just on disclosures, but also on technology, sometimes getting data directly, not having to rely on companies for that, because they don't all have the capacity to support that. So that is quite interesting in terms of closing the data gaps. Thank you very much. And also, I think the question that you posed about what can we expect and what is realistic in terms of waiting for the data, a quote came to mind from former executive board member of the ECB, and you mentioned the ECB, Sabine Lautenschläger, had said that climate change will not adapt to our research schedule. So we have to be realistic about how perfect we want the data to be before we act. Moving now to you, Jochen Thiel from Morningstar, to tell us a little bit around these questions of social and greenwashing that we heard about. Also, how can we make ESG inclusive? Because we want everyone to be sustainable, but at the same time, if we are putting very stringent expectations on compliance, on data, on disclosures, can we really bring everyone on board? An SME, for example, may not have the same capacity to fill out all the data requests that an investor has compared to a big company that has more capacity and resources to do that. How do we make ESG inclusive, but at the same time maintain the rigorous standards that mean we can avoid social and greenwashing?
Yeah, thanks a lot, Danny. I think we already heard quite a lot of very true statements from Mr. Wenzel, from Mr. van Bilsen, and from Mr. Helmich. I think what I would like to try now is to also provide some data around what has just been said. And I would like to start in investors' behavior. As Mr. Wenzel already mentioned, he sees significant changes in investors' behavior. And also Mr. van Bilsen, Mr. Helmich said that it's already proven that sustainability and performance do not contradict each other. So what do we see in investors' behavior here? In the third quarter, for instance, sustainable funds and ETFs in Europe reported net inflows of 55.5 billion euros compared to 52.6 in the second quarter, i.e. an increase of 10% here. They accounted for more than 40% already of the total net inflows of all European funds. And in September, they even accounted for more than 2/3. So I think this is a clear measure that shows a change in investors' behavior. In the last 9 quarters, just another example, there has been only 1 quarter in which the net flows into sustainable equity funds has been lower than the ones of conventional equity funds. And this trend seems to even have accelerated during the corona crisis in the first and second quarter. So all we see here is a clear trend towards sustainable investing driven by investors, even without a major part of regulation being in place right now. It's something that we envisage, but it's certainly something that has not triggered this trend. And this trend is not only true for institutional investors, where we have seen that trend for a couple of years already, but it also became more and more true in the last, I would say, 2 years for the retail investment community. Now, how can regulation support this trend and also support the issues that we just experienced around data especially? I think first issue here is that the current regulation and EU taxonomy in particular mostly focuses on mitigating climate change. An element of the non-aligned taxonomy investment will remain for those products, for most products, because the taxonomy reporting obligations fall upon the largest company only. So as you just questioned, SMEs are not necessarily covered here. And thus, there's only hope rather than an expectation
that smaller firms will voluntarily adopt these regulations. And as a consequence, from a financial market perspective, many financial products will be invested in many companies that are not obliged to report taxonomy alignment. This automatically also leads to the question, where do we get the data from? We already heard the right statement from Mr. Helmich. Again, I think I can provide an interesting number here that I just heard in another panel discussion last week. There is an estimate that currently less than 10% of data is available, which is needed to fulfill EU taxonomy reporting requirements. Again, just an estimate, but probably not far from the truth. Data providers like Morningstar can certainly help to collect, categorize, quality check the required ESG data. We can also help in setting global standards. Another issue, I would say, which is not resolved at all right now, by introducing methodologies for ESG risk assessment, ratings, etc. So we can certainly facilitate the transformation process and ease the decision-making for investors. But today's main challenge, and I just repeat what Mr. Helmich just said, is the missing data and missing disclosure rules for large parts of the industry. And I couldn't agree more that coordinated actions of all players in the industry, including regulators, including supervisory bodies, is required here. It's not a single body that can make the change. And finally, there's one more aspect that I want to highlight here. I think what we will also face in the next couple of months and years is the question, do we have the right know-how available? Do we have the teams available that can work on the projects that Mr. Helmich was talking about? And I think there's a massive demand for special know-how for building up those teams. So I am also sure that the HR departments, both on the regulators, on the supervisory side, but also especially in the industry, will be very, very busy in the next couple of years.
Thank you. Yes, absolutely. I think it's a situation where we have the kind of supervisory authorities, the policymakers, the investors, the data providers all coming together to create this ecosystem, and it's kind of coordinating all these different parts of the financial system puzzle to work together, but also making it inclusive. Thank you all for your introductory remarks. A reminder to the audience that you can send through your questions at this stage. So it'd be great to involve you as well and to get your questions to the speakers. Perhaps I'll kick off with one, which is that for the past 2 or 3 years or so, we've seen a lot of focus and advances in the area of climate change. Of course, that has been the kind of main focus when it has come to ESG investment and regulation. But COVID-19 has sharpened the awareness that financial systems are vulnerable to non-financial sources of risk. So that is, of course, supporting the climate agenda, but it has also brought to the attention of policymakers, of investors, other parts of ESG. And we heard from Governor Wenzel at the start in terms of the social side, the S part of ESG, and how that has perhaps pioneering from your side has been always a big focus. But my question to all of you would be, how can we transition from a system where there has been a lot of focus on climate change to somewhere where we understand ESG more holistically? Do you think the fact that we have already made progress on the E part can speed up progress in the other areas, or do you think it can be overwhelming for investors, for regulators, just as they're coming to grip with the E parts, to now have to look at all these other factors as well, to have to move to a system where they consider things more holistically? Do you think it will be easier because we've already made some progress on climate, or do you think it will be more difficult because now it's more overwhelming? Perhaps Governor Wenzel, to you first, given that you've worked both with S and E for quite some time.
Well, thank you very much. It was interesting to listen to our colleagues on the data, but maybe we can have another round on the data and the measurement, the methodology, whether it's accepted, and the new players emerging in the markets, like those who provide the data, will they be reliable, credible? All important issues for the years to come. Now, to your question, Danae, I think indeed that the COVID pandemic, I don't want to be cynical or ironical, but I think it one more time underlines the need for societies to move more towards fighting global warming and being very conscious for investors, but also for those who finance social infrastructure like us, to be very conscious of the fact of the impact of your undertaking on environment and sustainability. And I think that has become more acceptable. This is why the EU will spend in the next couple of years focusing so much of the financial power on sustainability. And everybody seems to agree, one has to see it in practice, but everybody seems to agree that after post-COVID, it's not going back to 2018 or 19, meaning we just continue as we did before the COVID pandemic. It has to change. Issues like Paris Agreement on climate, all the things that we see, and even the COVID has a relationship to climate and environment. I think that has, and remember the younger generation that went on the streets, Fridays for Future, all this is not going away. At least this is our impression. This is not going away because of the pandemic. It's even more so important, and this is why I think investors are becoming, throughout 2020, this is our impression, becoming more conscious, more interested in this part of the financial market. And they want to invest because they feel the pressure from their clients, from their investors, but they also believe this is the right thing to do. So to answer your question, yes, I think it has become more accepted, and it might be easier in the future to invest in the E and in the S. And of course also in the G, if you like.
Thank you. Maybe just to press you a little bit on that, because it's interesting that you brought up the motivations and you said that, it's because what the clients want, what the public wants. Some institutions have a public ethos as well. If we think about the regulators, if we think about the public investors, like a sovereign wealth fund, for example, or a pension fund. But at the same time, it's also the realization that they have to protect their own portfolios from risk. And these are two slightly different things. I mean, of course, they're linked. But I think if you are, as an investor, looking at this more from a reputational point of view, from this is what the public wants, you may take a different investment strategy than if you're thinking about, I need to protect my portfolio from risk, or I need to minimize the impact that my portfolio has on the environment, which is the other side of materiality, not just what the environment does to my portfolio, but what my portfolio does to the environment, because I also care about the long-term sustainable nature of growth. So if you are, for example, a big pension fund and you want to be on the Christmas card list of Greta Thunberg, you may completely divest from oil and gas companies. But if you really want to support sustainable growth, you may say, well, if I divest, someone else will invest in that. So I'm actually going to invest, but steer them in a sustainable direction and use my power as an investor to do that. So you have very different outcomes depending on what your motivation is. So my question would be, where do you see the balance between the reasons why investors are now becoming interested in ESG? In the beginning, it may be that they are motivated by this reputational risk, but as they realize and start measuring and the data become available to see what the risk is actually to your portfolio and to the outside factors, do you start to change a little bit your approach? But what has been your experience of this? And maybe the rest of you can also come into that question later.
Well, take, for example, the Norwegian Sovereign Wealth Fund. As I understand it, they completely moved out of certain areas like oil and gas. By the way, even gas is a complicated issue, whether it's, but again, so there are measurement issues, impact questions. So they have moved out completely. Other, for example, public pension funds have started to set up particular funds only devoted to sustainable financing, and they have a running 2 funds in parallel. So you can decide as an investor whether you want to buy the one or the other. But I think, again, our impression here is that because of the public sentiment and the power that some of these funds have, questions being asked, how do you behave? What do you do as a pension fund? They're asking investors, and even behavior, how do you ensure a gender balance? And all these questions are coming more important, more public being discussed. Also that investors are considering how to vote in a corporate decision setting. So all this, I believe, is a difficult thing sometimes to find the right balance to meet all the different requests or demands from your investors. But I think this is something that we just heard, for example, that the sustainable funds are not performing worse than the others. So if you can prove that it makes sense economically, financially, to invest in sustainable financing, then I think you can win over more and more of your customers, of your own investors, to go in that direction more or even completely.
Yeah, thank you. And that's a very good point also about what outperforms or not. And it may be that we don't need ESG to outperform, because in the longer term, perhaps the prices of the dirty sectors will adjust. And that is where we may be mispricing things now. Jan, over to you. What do you think about these questions of moving beyond climate to a broader understanding of ESG, and also the motivations and how they may impact investment strategies?
Yeah, I think that indeed, to follow through on the last point that Dr. Wenzel just mentioned, is I think you need to show the benefits, right? Because I mean, for investors, basically maximizing financial returns is still the main driver. So if you cannot demonstrate that this also makes financial sense, then only maybe a very, very small portion of the portfolio will go into it for ethical reasons. But that can really grow indeed if you show the benefits as well. So hence that we indeed, as I said, as IFC, we have done quite some work on that for our own business. And we finance about $20 billion into emerging markets every year. So it's quite a large portfolio. So the numbers work. And so I think that is one. Just to illustrate, during one of our last bonds that we issued, as you just mentioned, we also are an investor in bonds, but we also issue ourselves. We noticed that a very large UK pension fund indeed is changing the mind for the simple reason that the management got a bit younger at that institution. And basically with the younger generation, the mindset is already a bit different anyway. Let's say the millennial generation. So that also helps. I think that generally, let's say the culture change takes place as well. But I think particularly it is to show the benefits. And hence, I can tell you what we do as IFC. We focus more on indeed telling the story. Indeed, tell indeed the audience, tell the investor base, but also issuers. Because why would they issue, right? When we support them indeed as an issuer and become an anchor investor, for instance. So indeed, tell the successful stories. And then another point, I think, and this goes back to the impact investor principles that I mentioned earlier. This sort of compares a bit, if I compare this with the Equator principles, which were developed 20 years ago. At this point in time, as you may be aware, the vast majority of project financing, limited recourse project financing globally, is according to these principles. So in other words, you sort of, get into a landscape whereby people start wondering if you do not comply with those principles, right? So what we already have noticed with the impact investor principles, and these were just launched only 18 months ago, is, of course, there are a large number of DFIs, development finance institutions, who are members, but those who have not signed up, they feel the pressure. They feel the pressure like, why don't you sign up to this? And so gradually you will see the same with non-developmental financial institutions indeed as well. So I think it's also setting indeed the trend and the example. So all of this takes time, but as I just said, you need to show the added value, of course, to the investors of why to do this. But I think, and that's why you mentioned the turning point that we have noticed, that we are sort of noticing.
Thank you very much. Over to you, Martin, to reflect on these questions of the different investment strategies. You spoke a little bit about that before, and also the kind of broader senses of sustainability.
Yeah, let me highlight, because we just discussed about different performance of different investment strategies. Let me highlight one very important point. As a mathematician, I'm not a specialist of psychology, but several months ago, I read a very interesting academic paper. They compared in specific periods of different years, periods with outstanding high temperatures, periods with outstanding natural disasters. They studied about the trading liquidity of different kinds of assets, assets with high financial instruments with high CO2 intensity compared to financial instruments of issuers with low CO2 intensity. And they found out that in specific periods like this, the liquidity of instruments with high CO2 intensity was lower, which means trader made lower turnover, trader kept hands off. I was also in my professional career was working long years in trading rooms, and it's very clear that it has something to do with psychology. In situations like this, we have all in our mind that something very fundamental have to change here, and without a specific return expectation, we change our behavior. We have changed our mindset. And that is a very important point, and it is also very far-reaching. If the mindset is changing, then we will see in the future, of course, cost of debt, cost of equity, credit spreads of companies with high CO2 intensity will show a better behavior, a lower performance. We will see that companies which do not disclose, which do not fulfill requirements, they will have more difficulties to fund their projects. So from that point of view, in general, I do not believe that the majority of investors have specific return tower or to really expect that green investment will show necessarily higher performance than others. I think it's really a change in the mindset. And the first hint I got was really that paper comparing liquidity of instruments with different CO2 intensity in specific time periods. So at the moment, indeed, mindset is changing. And by the way, COVID is also another very interesting period. COVID and climate change, from the first point of view, these are two complete different things, not necessarily correlated. But COVID showed us that we can, with a complete different work and lifestyle during COVID times, which still is the case, shows that many things we believed in former times being necessary, so expensive office buildings, long intercontinental flights for going to conferences, we had all in the past in mind. These are things being absolutely necessary in our professional activities. With COVID, we see it is not necessary, and so COVID, I think, has accelerated the change in our mindset. So I do believe not the point that necessarily green investments will show better performance. It's a mix of many things, yeah. But the psychological mindset is, I think, a very driving factor here.
Thank you very much. Introducing mathematics and psychology into economics and politics, a very multifaceted subject indeed. Jochen, to you, last but not least in this round, we've spoken a lot about data, but there is a kind of whole other agenda when it comes to data privacy laws, disclosures. How do we marry this with the need to have more transparency when it comes to ESG, and also what may be some of the more practical hurdles that we may see when it comes to data collection? Could you tell us a little bit about that?
I actually thought about specifically answering that question about the challenges on data collection, but having listened to my panel colleagues here, I think I want to turn into a slightly different direction here, because I think what we've seen with EU taxonomy, with what we've just discussed, with all the trends that we see, we only spoke about the financial markets and how we can regulate financial flows in order to facilitate sustainable investments. Having said that, we spoke earlier about the social aspect, and are we well prepared with all the data that we are now collecting to also move towards also making the social environment more sustainable? And there, I have to be honest, I have my doubts. Even though as a well-known company for its research and ratings like Morningstar, we do a lot to empower investors to provide for better performance, but now also to provide for sustainable investments. For instance, we have just announced that we are going to integrate Sustainalytics ESG data into our research methodology, into our ratings for equities, into our ratings for asset managers, for investment strategies. So we do a lot into that direction. But I think it's also, I wouldn't say easy, but the financial industry is used to deal with data. So I'm confident that by now, taking step by step, we will head into the right direction. I want to go back to a sentence that Mr. Wenzel said earlier on. We must not go back to where we have been in 2018, and I couldn't agree more. However, I think it's probably not sufficient to regulate financial markets, to regulate financial flows. We have two more areas where regulation can do good. This is regulating the production industry, and this is regulating consumers, which admittedly is more complicated and also from a political standpoint probably more challenging than regulating the financial markets. But just look at the examples. When Germany announced that we will no longer create current from coal, that we are going to invest in sustainable energy and no longer in nuclear energy. This has immediately triggered significant changes in investor behavior. Many asset managers divested in these industries. So these kind of bold moves also show that maybe even faster we can move to a sustainable environment. And coming back to the social aspect, I think there it's good to have data, but I think it's even more complicated when you look at the worldwide supply chains that we have. How do we manage those? Do we have certifications in place for these supply chains? And one particular example that crossed my mind during the discussion here is after the first lockdown here in Germany, I went along Zeil. And I realized that only one day after the lockdown, there were huge queues in front of well-known shops with very, very cheap textiles. And I really asked myself, people were at home for 2 or 3 months now. There should be enough in the cupboard. So I truly think that we need a mind shift, not only in the investor community, but also on the consumer side, if we want to move into that direction. So coming back to coordinated activities, I would really wish that we do not only focus on the financial markets. It's a right thing to do, and we've done the right steps, but there's more to do.
Well, thank you very much. And I think the issues around supply chain tracing are very important, but it's encouraging that, as you said, the financial sector has dealt with very complex data issues before, and we can do it again. We need to build back better and more sustainably, and the direction from policy, as you said, for example, what the German government did is also very important in terms of creating these incentives for investors as well. We are coming towards the end. We will now set up the studio for the closing remarks by Mr. Frank Scheidich. Thank you very much to all our panelists for your interventions today. We've learned a lot, expanding the focus from climate to social, and governance has always been a focus as well. The perspective from the issuers, what kind of developments we need to have there, and also how to scale up issuance. We work a lot with investors as well, who often complain about a lack of supply. And we spoke about this when we were preparing the panel as well, in terms of how we can scale up sustainable capital markets as well. The demand is there. We heard about the motivations for Mr. Wenzel, the kind of risk management, but also aligning investments with what the end stakeholders may want. And there is the demand, but the supply is not always there. So how can we make this progress in terms of having more availability for sustainability? But we are seeing big steps in terms of data that can enable more structured and focused strategies as well. So thank you very much to all our panelists for your contributions today. I'll now hand over to Mr. Frank Scheibich of DZ Bank to offer some closing remarks. Thank you.
Denai, thanks very much. Thanks to everyone. I think we had a great day in our series Future Europe, Sustainable Europe. We will continue to do so in the next couple of years. Next session will be early March. I guess it will be half a day, probably a little extension. We saw today, if you take the first session and the second and the third, we would need it to have at least 15 to 20 minutes more. It is such a great topic, and I can just thank everyone who has contributed. Thank you so much. I'm looking forward to a sustainable Christmas time. I hope for you and your families you will have and enjoy the time, and stay healthy, be fit, and we see each other hopefully also physically sometimes next year. Thank you very much for coming in and listen to us and contributing with questions. Thank you all. Stay healthy.